Hi traders, welcome to Market Outlook, trends, risk events and trade setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both technical and fundamental, driving markets at the moment. I'll just firstly let you have a quick look at the disclaimer before we get into the main chunk of the webinar. Okay. Yes, here we are. Here are the main sections of the webinar. Great to have you all on the call. And for those people who haven't quite tuned in before, then hopefully this will prove of use to you. We'll follow the usual format. So we'll just check out how markets are shaping up currently. As you can see, we'll then check out some of the technicals around some of the main US indices, the stock indices, that is, before then reviewing last week's main data points, which are all inflation based, as you can see. So the US core PCE and the Eurozone inflation data that was out on Friday, Tokyo inflation too, actually. So all Friday's inflation data, the key events really from last week. So we'll review those before then getting into the main events of this week. Really busy, action-packed week, really. Kicking off with some of the big central bank meetings, the ECB, of course, and the Bank of Canada. The day before, the ECB on Wednesday, the Bank of Canada. And then we wrap up, of course, with the monthly US employment data, which is the non-farm payrolls, of course. So, yeah, busy few days ahead of us. Yes, should be quite potentially quite volatile, shifting sort of ebbing and flowing, really, I would say. But we'll get into those in more detail shortly. Could be conflicting signals and really be quite interesting in terms of price action. As for markets currently, I'm just checking out where we are at the moment. If I just pull up, first of all, this chart, and I'm just checking where markets are currently. So, yeah, pretty strong start to the week, actually. Well, certainly in Asia, positive session. Japanese and Chinese stocks up 1.3% and 2.4%, actually, respectively. The Caixin manufacturing PMI for May out of China, that printed at just above expectations, 51.7 versus 51.5 and the prior 51.4. So remains above 50, that 50 mark, denoting expansion, remains in expansionary territory, as it has been since last November. And in fact, the figure actually hasn't printed as high since June 2022. So that certainly gave a positive uplift to risk taking. Following on from Friday's actually half decent performance out of Wall Street. We also had PMI data from Taiwan and South Korea, actually quite interesting, quite promising. Those data sort of leading indicators, if you like, for the global economy potentially. And then we had exit polls in India after the protracted election, of course, 6-week election, really suggesting, of course, another strong term for the incumbent Modi. European equities are in the green as well. US futures, just checking those. Yep, just about modestly in the green as well. There is a sort of spotlight on French banks after the S&P lowered France's credit rating. They highlighted missed fiscal goals to rein in spending, but nothing major on that. The dollar, just checking out the dollar. We will look at this chart shortly, but just checking out marginally in the green ahead of this big week. As I said, euro will be in focus with the ECB basically cutting rates, but then inflation came in higher, of course, on Friday. Canadian dollar, the loonie will also be in the spotlight with the Bank of Canada meeting Wednesday. That's slightly more uncertain about the rate cuts, but markets pretty much pricing it in around the sort of 60-70% mark, I think, now. So pretty certain, but some uncertainty, should we say. Commodities, oil and gold. And if we just pull up the gold chart, first of all, actually, here's the daily gold chart. fairly flat, slightly modestly higher. You can see gold did drop actually to 3-week lows on Friday, despite that slightly softer US inflation gauge, and the dollar as well, as treasury yields falling, so giving a lift to gold bugs. You can see the blue line is the 50-day moving average. Sorry, that's at 2331. So we're just sort of hovering around the week's support, really. If we do lose this, then potentially we go down to this sort of protracted area around 2300. Otherwise, if this is support, then yeah, we can push up to 2350 and beyond those recent highs from last week at 2362, 2364. Oil, just checking after the OPEC Plus announcements, there is a plan to gradually restore some suspended production starting in October. There are concerns within the group, we should say, about demand, and strong supply from others may also weigh on prices unless really we see robust summer demand. Of course, we're coming into the driving season in North America, although it is cooling demand in Asia and parts of the Middle East as well. We look at fixed income, so that is bonds. We don't normally get into too much detail about treasury yields, but we always like following the 10-year treasury yield. And if I just locate that chart, which we did have here. So this is the US Treasury 10-year yield. This is essentially a global proxy for borrowing costs. So that's why markets focus on this 10-year US Treasury yield a lot. You can see, hopefully this isn't too complicated. Let me just probably take down some of these. This is the daily RSI. Pretty coming just back down below 50. So sort of neither bullish nor bearish momentum. You can see the 50-day moving average here, the blue line, that's at 4.48. But you can just see the pickup. Or actually, if we go back to May, just to give you some sort of clarity on this. So May yields move lower, but you can just see the sort of quite wide range, really. So May we sort of fell initially, and then we sort of picked up in the middle of the month and picked up sort of from 4.35, that strong support level, up to sort of 4.6, and then we've just fallen back now over the last couple of days. So yeah, that's important really, because it then guides the dollar, of course, it guides interest rate expectations, and then guides sort of risk assets as well, potentially. Of course, higher yields, but ordinarily would mean a tougher scenario for growth stocks, for tech stocks, certainly. But then, of course, we've had the AI mania as well, the AI theme, obviously, probably trumping all of this at the moment. If you just bear with me 1 second, because we just have... yeah, somebody's just asking, actually, it was a great question. What indicators am I using? So if I just pull back here. So at the moment, well, you can see the bottom line is basically consecutive days. So a red line just denotes a down day. And it's a very simple indicator. I kind of use it just when I'm writing commentary more than anything, not trading especially. But you just see consecutive days of losses there. And then potentially, if you use that with other indicators, then that could signal a change in the trend. This next one above that is the daily RSI, pretty explanatory. Hopefully you guys understand that. So 50 is kind of middling, 70 is where the moving average is overbought, and then 30, the lower line, is where prices are oversold. So again, in combination with other technical indicators, I use that with, then we have the blue line, which is the 50-day moving average, and the black line, which is a 200-day moving average. Kind of, me personally, I don't use those as much, but I think they're a nice guide because they are widely watched, especially the 200-day moving average. If that sort of acts as resistance or support, then it's widely cited, of course, in the media. Many people watch out for it, even though they might not use technical indicators to trade. So it is just something I always think to note of. But then I use as well the Fibonacci retracement levels. And that is those dotted lines there. So you can see, if I just pull back slightly, you can see I've gone from the high just in October last year down to the low in just at the start of this year, end of last year, actually. So that's the high low. And then you have Fibonacci retracement levels. So 38.2. The halfway point is not really strictly a Fibonacci, but we like to put it on there, of course. Then the 61.8, and there are wider ones beyond those, actually below 38.2, 23.6, and as well 61.8, which above that would be 78.6. And in fact, probably quite a nice one to put on here, because it just taps that high. So, for example, this is yields, but we can use it elsewhere, and I do use it elsewhere. So you can just see sometimes these will act as a point of reference again for support and resistance lines. Those are the indicators, as well as one other, which I don't want to complicate things too much. But if we go to, say, the DXY chart, you can see again some Fibonacci levels. From the low late last year up to the highs here. And I just would normally ordinarily use the Keltner channel as well. So it's kind of, I don't want to get too confusing, and hopefully I'm not confusing you too much. But again, I use Keltner channels, which are here. And these just give me bands of essentially oversold, overbought. So if we're tapping the upper band, then we're overbought. If that tallies with, say, the RSI there, you can see potentially is warning us of a correction. Similarly here, you can see we tapped it, we bounced, but then obviously we carried on going lower after that slight correction. And then you can see we were overbought both through the bottom Keltner channel, and potentially the RSI was around 30. So warning of correction, reversal of trend, and then that's what we got. So hopefully that answers a question for you. There are a multitude of indicators, obviously, to choose from. I would also always say these I've used for many, many years, really, and a combination of these plus fundamentals as well. And then I also like to use simple patterns in candlesticks. So for me, I would use a momentum sort of pattern and range contraction, and then after a period of range contraction, so small ranges, then we have a burst of range expansion, generally to or in line with the dominant longer term trend. So for here, example, sharp move down, then we have range, so range expansion, then range contraction there, small ranges before then we go again, break to the downside, in line with that dominant trend. Okay, hopefully that's answered the question for you. And here is the chart, actually, which you may not have seen. But yeah, just another point of reference for the DXY chart. You can just see these Keltner channels here, and then Fibonacci's as well. I'll just take the Keltner channels off for now. Generally, I sort of write about the Fibonacci's and the 200-day and 50-day moving averages in the daily commentary, because I know that a lot of people follow those, so they are of interest. And then certainly if we break one or one holds as support, of course, then they are, as I say, very good point of reference. Okay, we'll just get quickly into global equities then, and stock US equities. Certainly they concluded global equities in May on a high note, really, after a strong beginning, at least. If we look at that's the monthly chart, and then you can see sort of start of May, decent up to fresh record highs, and then just a slight pullback, really. The final day of May, that ended with the positive figures, of course, mirroring the start of the month. Lower yields, as I mentioned, diminished inflation fears, kind of primary catalysts for that upward move in equities on Friday. During May as a whole, though, there was Well, with regard to equities, there was slightly disconcerting sort of single sector rotations, kind of partially due to regulatory influences, partly due to positioning. Um, but then when summed up, so essentially growth, momentum, cyclical sectors, they outperformed basically minimum volatility and defensive sectors. And we saw that certainly with the NASDAQ going higher, whereas the Dow fell quite sharply, although it did bounce back in the last couple of days of May. So just on the S&P 500, just technicals wise, you can see we didn't quite tap that blue line, the 50-day moving average at 51.81. I've still got in here this cycle high from April, just as a point of reference again. And interestingly, we're just closed above that line now. So potentially that is a good sign, especially that candle there where yeah, we did drop quite sharply, but then buyers stepped in, dip buying stepped in, and then we pushed above that previous cycle high, as I say, at 52.64. So obviously, bulls will target the record high, intraday high, that is, at 53.41, with the record close being at 53.21. We just move on to the NASDAQ. Again, really positive sign on Friday, even though we didn't close high. You can just see that rejection of that move to the downside, and denotes really quite a positive, quite positive price action from Friday. So again, we've just closed higher above that previous cycle high at 18,864. This is NASDAQ 100. So potentially that does see that we move towards 18,800 again in the NASDAQ. Dow, you can see that difference. So the underperformance basically of defensive sectors, although we did get a nice bounce on Friday. I think we fell nearly close to 5% on the month from the high down to the low, close to 5%. But yeah, decent bounce on Friday. Salesforce, obviously, they had disappointing results, and that stock closed down, I think 19% or so, or certainly opened up after its result 19% or so. So that didn't help. But yeah, decent bounce on Friday. And you can just see these different fib levels here. With this, yeah, with one of them 38,146 acting as support. Quite a lot of levels on there, so you kind of would say, if you're a skeptic, that they're going to work at some point. But yeah, always of interest. That's the blue line tallies with the halfway point of this move higher. That's a 38,848, which is also pretty much the 50-day moving average. But again, decent support. You can see definitely around sort of 38,000 and just below. Big zone of support there. So interesting for the Dow, especially with this bearish momentum, although it's been halted with that one day on Friday. Very strong day, 1.5% up. Okay, let's move on now to just last week's main data points, first of all, which are here. So US core PCE, then the Eurozone CPI, and then Tokyo CPI as well. We'll look at briefly. So here's a chart really of those numbers. Well, the core PCE plus the CPI data. Remember, it's the Fed's favored inflation gauge, the core PCE deflator, basically because it sort of tells well, it's broader in coverage, really, more than the CPI data, which is consumer based, of course. In the Fed's view, they see it better representing the core PCE, better representing spending patterns of the US consumer and also businesses. So the deflator, the core deflator anyway, that rose 0.2% month on month, so lower than the prior, and 2.8% year on year, which was unchanged. The consensus was actually 0.2 to 0.3 all week, really. So due to those inputs from PPI data and the CPI data, of course. And interesting, we're kind of getting down to watching decimal points, really. And the print actually came in, well, to 3 decimal points if you look at it, at 0.249. So actually not far off 0.3, but we rounded it down to 0.2. Economists, I always say this, generally want a figure month on month over a few months of 0.17% to bring inflation back to target. So kind of will soothe their worries slightly, of course, after those upside surprises at the start of the year. But really, we need a series of these kind of readings, 0.2 and below, really, between now and September, with probably then further slack, if you like, which means unemployment rising to probably 4.2% or so, to see then more evidence of cooling consumer spending story, and then that chance potentially of a pivot and a rate cut, obviously, by the Fed. We're not there yet, certainly. And the report actually was elsewhere was actually quite weak. Consumer spending, that was down negative 0.1%, from a revised prior 0.4%. And then real household disposable incomes, they were down for the second time in 3 months. So just a couple of signals there that potentially we are cooling, although it is uneven, and it is gradual for sure. So that was core PCE. If we just go to Eurozone inflation data now, here's a graphic really of the main numbers. The figure here is called HICP, really CPI equivalent in the Eurozone for May. That came in slightly higher than expected, really 2.6% versus the prior 2.4. Consensus was 2.5%. That actually was in line, the higher than expected print, with sort of signals from the country data released a couple of days before, or in the build up to this number on Friday. Core inflation, that's the one the ECB officials look out for, really. That printed as well higher than expected, 0.2 higher than expected, 2.9 rather than the 2.7 prior, and what consensus expected. Services inflation, again, a key number. I should have had it in here. I do, but not the actual number. That came in very strong, rising 4.1% from 3.7%. So that certainly remains elevated for now. If you listen to our webinars and everyone else, really, services inflation is key, really the key number. If you ignore the headline number, you look at services inflation, that's been elevated for some time now, and forward-looking indicators, well, they do gradually move in the right direction, but certainly if goods demand returns on the back of higher real wage growth, then goods inflation could also accelerate potentially towards the end of the year. Really, a supply chain problem still modestly curbs supply. And all around services inflation, of course, is wage growth. That's the key element, really, in bringing down inflation if it can. But again, that surprise to the upside in the first quarter. We talked about that last week, and that a Q1 wage negotiations figure higher than expected, even though the ECB actually did dismiss it, really, as resulting from a German one-off payment, as other countries really saw faster deceleration. Unemployment, of course, if you think about macro picture now, record low of 6.4%. The decline in wage growth over the rest of the year really does then remain uncertain. As for these figures, the HICP figures, CPI data, really, economists expect inflation will hover around 2.5% over the next couple of months due to rising energy inflation and that sticky services inflation. After the summer, headline inflation is expected to hit 2% in some months due to the energy base effects. But sticky underlying inflation means it only to sustainably converge to the 2% target, potentially not until next year. And we just got this chart here that you can see just before those numbers were released on Friday. So just an uptick in these numbers now, which will be of a concern to the ECB. We will get onto. I said I'd also touch upon actually Tokyo inflation just briefly, because it's a forerunner really towards the nationwide figure. So Tokyo CPI actually reaccelerated to above 2% in May after a sharp drop in April, broadly in line with market consensus. The headline actually rose to 2.2%. That was consensus as well. The core hit the mark, 1.9%, so above the 1.6 in April. Inflation in Tokyo has been quite choppy, really, due to various government programs and utility prices. This time, actually, utility prices were the main reason for the pickup, but other goods prices also rose modestly. As I say, this is a leading indicator for the nationwide CPI results, so that's why we focus on it, and markets do as well. So potentially, consumer prices are likely to jump back to nearly 3% over the next few months, from 2.5% year on year in April. And that really, as well, that's due potentially as well to the weaker yen. You have to think about that, of course, and then this large wage increase, which is potentially in the pipeline as well. So together we had stronger retail sales as well, plus this potential reacceleration in inflation really puts the Bank of Japan on notice. Certainly another hike in July, possibly next week, actually. Next Friday is the Bank of Japan meeting, the 14th. So potentially as well, either or there, but potentially we do get that hike next week. We shall see. Although we have had mixed data, I should say mixed activity data, generally, with private consumption a key number for the Bank of Japan as well. For dollar yen, then, this is the chart here that you can see, kind of governed by yields, 10-year yields, US Treasury 10-year yield, I should say, and of course risk as well. But you can see we're just sort of ebbing up towards these recent highs around 158. This is kind of yen intervention levels. Of course, you can remember just back in at the end of April where we popped up to 160, spiked higher, and then obviously intervention came in. I don't think we've had it official, but we'll see those numbers very soon, I think, if not this week. So just watch out here. Of course, 158 and above, then potentially we get more jawboning from Japanese officials for sure. Otherwise, 157 is a sort of fib level. And then the next one below that, 156.03. That is dollar yen. Okay, let's go on to this week. Much more important now, really, or much more exciting in a way. First of all, I'll give you. Here we go. Preview of, first of all, we'll look at the ECB actually. Then we'll look at the Bank of Canada and then wrap up with non-farm payroll. So ECB, here we are, a graphic with all the main numbers, the economic macro numbers anyway. Widely expected the ECB to deliver a 25 basis point rate cut, largely because the Governing Council have basically stated as much. And certainly they've been saying that in the last few weeks. We do get updated June staff economic projections, and they are expected to suggest that the prevailing economic and monetary policy narrative stays broadly unchanged. So this cut in a way is interesting, as we've had sort of that inflation data on Friday, of course, and then other data as well, seeing really the economy slightly pick up from this very low base, of course. Then this rate cuts may be framed as a sort of rollback of that sort of insurance hike, if you remember, from September last year. And then if we go back to at least April, the April meeting, the previous most recent meeting, deposit rate was left at 4% for the fifth consecutive meeting. And the statement was altered really just to point to potentially rate cuts beginning in June as well. So the statement said that if the Government Council's updated assessment of the inflation outlook, dynamics of underlying inflation, and the strength of monetary policy transmission were to further increase its confidence that inflation is converging to the target, would be appropriate to reduce the current level of monetary policy restriction. So that's where we are from the previous statement. This meeting, then, the Governing Council will probably retain an easing bias, but then they will certainly probably not be specific on when they may cut rates further. And then we'll probably hear a lot of data dependence from the Governing Council, also from President Lagarde at her press conference. As I said, the latest data kind of adds to doubts about the future inflation path. Forward-looking indicators kind of remain benign, but then we have this hot labor market, as I said, continued sort of supply chain disturbances, and then also a recovery of purchasing power, which all make, for an interesting debate after this meeting, really. And that's what's key, what forward guidance is given by President Lagarde in her press conference, if any, or she just says the Governing Council, the ECB, are cautious, will be gradual in any changes. And of course, then, as I said, data dependent as well. Markets really have nothing extra priced for the July 18 meeting, and then about half of another 25 basis point hike price for September. So certainly there's scope, really, if you think about it, for a near-term forward rate path to be impacted by President Lagarde's guidance. Whether we get any, of course, is a different picture. Let's just show you euro dollar actually now, of course, which if I just grab the chart, which is here. So you can just see this slight pullback after this decent run from those lows just above 106 in mid-April. Decent run up to sort of just below 109, 108.94, the high, then kind of tracking sideways really. Yeah, finding support really at one of these long-term fib levels, the halfway point of this Q4 rally. That halfway point you can see is at 107.93, tallies with that black line, the 200-day moving average at 107.87, just below that, the 50-day. So yeah, decent support around 108 for sure. Psychological number, of course, being a round number. So potentially kind of going on for some time really, so we're not sort of in any sort of protracted tight ranges really for me to denote strong breakout either way. Of course, conveniently 108 support, 109 resistance really, which potentially yes, we track sideways, then the bigger the breakout will be, but it's quite a wide range at the moment, so doesn't really tally with a sort of massive breakout, if you like. Bank of Canada, let's move on to them, and we'll look at dollar CAD next, which really, as I said, slightly more mixed. I think pricing was around sort of 65% or so, may have picked up slightly with the move lower in yields end of last week. Consensus, I think, slightly more torn as well. If we go back to the April meeting for the Bank of Canada, they kept rates on hold at 5%, though the messaging was slightly more dovish, setting the stage for rate cuts. Since then, domestic data has continued to move in the right direction. So we've seen the underlying disinflation trend, falling inflation basically, make further progress. 1.6% now, the 3-month annualized in April for the average of the Bank of Canada's 2 core inflation measures. So that is key, and certainly well within their sort of 1 to 3% target band. While, well, just looking at the headline, that fell to 3-year lows at 2.7% in April. We've also had economic growth that's been sluggish, while the labor market has cooled, even though we have had sort of decent, relatively solid gains in those monthly job numbers. And we do get that latest one on Friday, actually, along with the non-farm payroll. Interestingly, though, I think some economists really citing the sort of wider shift in expectations that we have seen recently surrounding the Fed over the past couple of months, and that may possibly cause the Bank of Canada to hold off just one meeting until July. That said, against that, Bank of Canada does like or is known to move against the tide sometimes, or move first. I think it did the jumbo hikes first, for example, and so it's not afraid to stand out on its by itself, if you like. But certainly, progress in domestic data means a cut in June is probably likely. But then policymakers, again, it's about forward guidance after this, and whether they signal, and it's likely they don't signal a start of an aggressive rate cutting cycle. Dollar CAD, you can see here. So we're just tapping this sort of, again, fib level of that Q4 sell-off. That's at 136.23. So decent support, really, quite a few times now in the last few weeks. So that'll be initial support. We've got the 200-day, doesn't really help us too much there. So I kind of then ignore that in some ways. Momentum, pretty neutral at the moment. So really, we probably need a break. 136.23 and then 136. And then potentially we move back down to sort of low 135s or so with that next fib level. Yeah, 135. Where are we? Just below, yeah, 135.42 or so. Potentially if we break that 136 level. Otherwise, if we push higher, say if Bank of Canada are relatively dovish, then yeah, you've got these two peaks here just above 137. Okay, finally, let's get on to non-farm payrolls. I've got a graphic for you to show you, which is the preview here, the main numbers. Hopefully these prove of use to you guys. So all the name numbers for what is expected. And yes, uh, yeah, just setting the scene, really. If you think about the recent weeks, we've had price data mainly as the focus. This week, really all about the second part of the Fed's mandate, which is, of course, maximum employment. So tomorrow, actually, just before we get to non-farm, we get the release of the JOLTS job openings data. That's the vacancies. That kind of goes to the heart, really, of the Fed's focus of balance returning to the labor markets. That's balance of supply and demand. Lower job openings will really reflect a better balance between supply and demand and will have implications really for how the Fed thinks about both labor demand and actually wage price pressures as well. But of course, the main event will be the Friday's monthly non-farm payroll report, the jobs report for May. April, that saw 175 increase in the headline. Which was below consensus expectations, actually, although still consistent with broad range of monthly increases seen over the past year. If we look at the beige book, employment rose at a slight pace overall during the period from April to mid-May. And a majority of, well, districts really noted better labor availability, though some shortages in certain industries. Interesting as well, some are citing that the data from last time may have been distorted by the timing of the Easter break, the early timing, that is. So possibly we get a rebound. Otherwise, consensus is expecting, yeah, 180 as in the headline print, and then average hourly earnings, 0.3. So unchanged with a yearly rate actually of 3.9%. And then unemployment as well, unchanged at 3.9%, with labor force participation holding steady, expected anyway at 62.7%. I've got the chances here of September Fed rate cut, so around 50-50, just above that, but pretty much a coin flip at the moment. Kind of think that an inline print really would really denote or really sort of be sort of relatively positive for markets, because that would bring down those longer term averages of headline job gains and see really the market cooling as well. And obviously we do get next week the FOMC meeting really, and since that or since previous data last month at least, we have seen, as I mentioned, this gradual slowdown. So yes, rate cut 50-50 in September, one, possibly two rate cuts at the moment priced in. So certainly more room if this report is weaker than expected. I should mention as well, we do get, of course, ISM data today, actually manufacturing, and then services on Wednesday. They will provide pretty important update on sort of business momentum as well as gauging price pressures. So let's just look at the DXY chart finally. Which is here. Always say this, but just remember the DXY is an index of some of the biggest trading partners of the US, but by far the biggest weighting in this index is the euro, so 56-57% or so. So it's kind of a flip of this chart, if you like, give or take. But anyway, just thought I'd point that out. So interesting, you've got the 200-day moving average, and you've got this upward trend line at around sort of 104.43, so offering initial support. And then you've got that recent cycle low, really, middle of last month, sorry, at 104.08. So watch out for those levels. We will be to hold as initial support. Otherwise, then we go down to probably the halfway point of this move at 103.56. Otherwise, upside, yeah, capped at the 50-day moving average. Those previous highs from last week around 105.09, just above 105. Okay, we will wrap it up there. I did have that chart as well. Apologies, just to, just to show you briefly, just the wider macro picture, if you like. So don't want to be too confusing here. So the orange line is the inflation number. You can see sharp fall, but still a touch sticky around 3.5%. But then we've got these average hourly earnings, that thicker reddish line, just falling down slightly. And then you've got the non-farm payrolls numbers, the bar, if you like, 180, previously 175, and then the unemployment rate, hopefully, well, for rate cut bets anyway, that picking up needs to go probably above 4%. Yeah, so that's the wider macro picture. Okay, we'll wrap it up there. Hopefully, being of use to you guys. Great to have you on the call. Just that one question. So, really appreciate you sticking around. And we will speak to you same time next week. Take care.